Lucid Group Inc. is currently trading at $5.87, representing a decline of 1.01% in today's session as of April 29, 2026. This price action follows a grueling month for the luxury electric vehicle maker, which has seen its market capitalization compressed to approximately $1.94 billion. While many retail investors are staring at the screen wondering if this is a bottom or a trap, there is a massive disconnect happening beneath the surface that the broader market has not fully digested yet. Most people see the 77% drop over the last year and assume the company is simply running out of runway, but the reality is that institutional positioning and recent strategic infusions have fundamentally altered the survival math for this company. We are moving past the phase of speculative growth and entering a period of forced consolidation and strategic relevance that most onlookers are missing because they are too focused on the price chart. The expectation from the general public right now is that Lucid is a sinking ship, destined to be a cautionary tale of the post-SPAC era. The reality, however, is that Lucid just secured a massive $1.05 billion capital injection through a public offering and significant private placements from the Saudi Public Investment Fund and Uber. This isn't just a survival check, it is a strategic repositioning. While the stock is flirting with 52-week lows, Goldman Sachs recently increased its position to 5.44 million shares. When the smart money starts picking through the wreckage of a stock that has lost 3/4 of its value, they aren't looking at the car you see on the street, they are looking at the technology and the partnerships that are being built behind closed doors. Recent trading volume for Lucid stock has been nothing short of chaotic. On days where the stock drops significantly, we have seen volume spikes of over 272% above the 10-day average. This level of churn suggests a massive transition in the shareholder base. We are seeing weak hands exit, while institutional players and high-conviction traders use platforms like the Fidelity mobile app or interactive brokers trading to accumulate at these levels. The volatility is being driven by a clash between two narratives, the cash burn bear case and the take private bull case. There is significant chatter in the derivatives market, with call option volume spiking 84% above normal levels recently. This indicates that while the spot price is depressed, a large group of traders is betting on a sudden, sharp reversal, possibly triggered by a total buyout from the PIF, which already holds a majority stake and effectively acts as the company's central bank. If you are using a Robinhood app or SoFi Invest to manage your portfolio, you've likely seen the alerts about Lucid hitting all-time lows. But let's look at the actual intraday mechanics. Even as the stock trades around the $5.87 mark, the bid-ask spreads have stayed relatively tight on the interactive brokers platform, showing that liquidity remains high despite the pessimism. Institutional activity from firms like AQR Capital Management and New Edge Advisors, who both doubled their positions in the first quarter of 2026, tell us that the smart money sees a floor that the retail market hasn't identified yet. They are looking at the $1.25 billion in cash and the partnership with Uber, which now includes a commitment to 35,000 vehicles for a robotaxi fleet. This isn't just about selling a few luxury sedans anymore, it's about becoming the hardware backbone for the next generation of autonomous transport. For anyone seeking investment help or looking at investing sites to make sense of this, the tension is clear. The market expects another round of dilution or a bankruptcy filing. The reality is that Lucid just named a new CEO, Silvio Napoli, an industrial leader known for cost discipline and scaling. This move is a direct response to the criticism that the company was all tech and no business. Napoli's job is to take the Atlas electric drive unit and the upcoming midsize platform and turn them into a profitable scale-up. This shift from a luxury-only focus to a midsize platform starting under $50,000 is where the battle for the company's soul will be won or lost. Let's break down the actual business for a second. Lucid isn't just a car company, they are a technology licensor in waiting. Their efficiency is objectively higher than almost anyone in the industry, including Tesla stock in certain power-to-weight metrics. They are now rolling out Apple CarPlay and Android Auto to the Gravity SUV via over-the-air updates, closing the software gap that previously plagued the brand. Their business model is shifting towards recurring revenue streams, such as software-defined vehicle features and fleet management services for their Uber partnership. This is a far cry from the narrative of a struggling startup that only makes a few thousand cars a year. They are building a diversified ecosystem that includes the Lucid Air, the Gravity SUV, and now the Lunar robotaxi concept. The recent earnings reports have been a mixed bag of high revenue growth, up 68% year over year, countered by a brutal gross profit margin of negative 93%. This is the reality that is currently crushing the stock price. It costs them more to build the cars than they sell them for, which is the definition of an unsustainable business. However, the bull case rests on the idea that this is a temporary scale problem. As they launch the Gravity and the Lucid Earth midsize SUV, the fixed cost absorption will improve. This is why we see such a wide gap in analyst price targets ranging from $1 to $30. It is a binary bet. Either they scale and the PIF continues to fund the gap, or they fail to reach unit cost parity and the stock goes to zero. Comment below how many shares of Lucid Group you currently hold, or if you've completely exited the EV sector this year. When you look at online investing trends on SoFi or Robinhood investments, the sentiment is overwhelmingly reduce. But remember, the consensus was buy when the stock was at 20. The retail investor usually gets the memo too late. If you are doing self-investing, you have to ask yourself if you believe the Saudi government will let their flagship industrial investment fail. The PIF has already invested billions and just put in more. They aren't just investors. They are the landlord, the lender, and the biggest customer. In many ways, Lucid is becoming a sovereign-backed entity masquerading as a public company. This creates a safety net that most other EV startups don't have, which is why LCID often trades with a PIF premium during periods of heavy speculation. Looking at the broader macroeconomic picture, the high interest rate environment has been a disaster for luxury EV demand. When you can get a 5% return on a Schwab Intelligent portfolio or a Fidelity brokerage account in cash, the appetite for a $100,000 electric car with high financing costs drops. This is why Lucid is pivoting so hard towards the midsize platform. They need to hit that $50,000 price point to survive in a world where the consumer is feeling the squeeze. Their Atlas drive unit is the key here. It's smaller, lighter, and cheaper to manufacture. If they can execute on this, the current $5.87 price will look like a historical anomaly. If they can't, then the cash burn will eventually exhaust even the Saudis' patience. Institutional activity in the last quarter has been telling. While some funds are dumping the stock to harvest tax losses, others are quietly buying the dip. Fidelity investments and various Fidelity ETFs have maintained significant exposure, treating it as a long-term tech play rather than a short-term automotive play. The stock's beta of 1.16 means it's more volatile than the general market, but not extremely so compared to its peers. It's a high-stakes game of chicken between the short sellers and the PIF. With short interest still hovering at significant levels, any positive news regarding the Uber partnership or a faster-than-expected ramp-up of the Gravity SUV could trigger a massive short squeeze. If you're using an online investment platform to compare Lucid to Nvidia stock or Apple stock, you're looking at different worlds. Those are cash flow machines. Lucid is an industrial project. The tension here is between the expectation of a quick turnaround and the reality of a decade-long capital-intensive build-out. Most investors don't have the stomach for that, which is why the stock is sitting at $587. But for those with a 10-year horizon, the technology leadership, proven by the fact that they have the longest-range EVs on the market, remains an incredibly valuable asset that hasn't been destroyed by the stock price decline. The individual brokerage data shows that retail investors are starting to lose hope, but that is often exactly when the bottom forms. We are seeing a capitulation phase where the news cycle is relentlessly negative, the analysts are all downgrading, and the stock is at multi-year lows. This is the environment where a take-private offer or a massive strategic partnership usually happens. Whether it's through Fidelity Wealth Management or a simple Robinhood app, the key is to look at the enterprise value relative to the technology. Lucid's IP alone is worth billions, yet the market cap is barely scraping $2 billion. To summarize the situation for Lucid Group Inc. on this April 29, 2026, we have a stock at $5.87 that is being priced for failure despite having over $1 billion in fresh capital and the backing of the world's most powerful sovereign wealth fund. The expectation is that the cash burn will win. The reality is that the company is undergoing a radical management and product shift that aims to move them from a niche luxury player to a mass market tech provider. The contrast between the falling stock price and the increasing institutional and strategic support creates a curiosity loop for any serious investor. Either the market is right and the company is a black hole for capital, or the PIF is right and they are building the next global automotive powerhouse. The truth likely lies in the middle, but at these price levels, the margin for error has become paper thin. Whether you're using SoFi Active Investing or Interactive Brokers platform, the data suggests that the next 6 months will be the most critical in the company's history. The floor is being tested, the technology is being scaled, and the reality of the business is finally starting to catch up with the lofty expectations of the past. Maintain your focus on the delivery numbers and the progress of the midsize platform, as those will be the true indicators of whether this $5.87 entry point is a gift or a trap. Authority in this market comes from recognizing that price is what you pay, but value is what you eventually receive once the noise of the daily candles fades away. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.